By the way, you can always tell what any attorney's answer is always going to start with, right? Robert, how many times do you say it depends every day?
All the time.
All the time. In fact, that's the name of his law firm, guys. It Depends Law Firm. All right, Robert. So let's jump into the 10 things that you see people do incorrect in business. Let's jump into that and give people what they came here for.
That sounds good. I structured this with 5 today because I know we were supposed to do a 2-part series. So
perfect.
And we'll
I love it.
All right, sounds good. First one, I'm sure you guys have all heard of this concept of piercing the corporate veil. So like I said, I tried to structure this to be beneficial for you guys as real estate investors. There's really 2 ways or 2 tests that courts will try to go after you for piercing the corporate veil. It's called either the alter ego test or instrumentality test, just depending on what state you're in. That test basically just says, is this business and the person so intertwined that it's essentially one and the same, right? And the second test is the undercapitalization test, and that's asking whether the corporation was adequately capitalized at the time of formation based on any foreseeable liabilities. So for that test, there's not a clear dollar amount that you need in a bank account to satisfy this. Obviously, having insurance protection helps. You really have to take a look at, what type of business am I in? If I'm in a dog grooming business, I probably don't have a ton of liabilities. If I'm running some type of a chemical manufacturer, then I probably have higher potential for liability there.
Okay, so what you're saying is we don't want people to have the ability to pierce the corporate veil. Does anybody not know what piercing the corporate veil means? Because I'll dumb it down for you. Pay attention. This is a really good one. This is going to come up so many times as a business owner. Take notice and write this down, guys. Piercing the corporate veil means that when I start an LLC, right, or a company in general, what I assume I've done is I've created a protection or a layer between me and the liabilities of that business, right? Do you understand that? What happens is, let's say that I start using the LLC to buy Disney tickets from my family, and I take my family on vacation with the money from my company. Does that tell you that the business and Pace are actually the same person, or does that show a judge that those are 2 different people? What would you guys assume? Is that 2 different people or one person using the same bank account? Okay, cool. So could you agree that maybe a judge or another really smart attorney, actually this is kind of like courtroom 101, you would essentially try and pierce the corporate veil. If somebody's trying to sue me, let's say one of my tenants is trying to sue me personally, wouldn't it be smart for their attorney to try and pierce my corporate veil, which means prove that Pace and his LLC are actually the same person, because Pace does what is called commingling of funds. And he's using the same money in that LLC to do stuff. And by the way, I've done that a lot. I have done that a lot. I'm sure Robert has seen a lot of business owners do that a lot. In fact, some of you guys in here right now, I'm looking at the side chat, a lot of you guys do that, and you need to stop. Stop. It's so easy, and it is bad, okay? That's piercing the corporate veil, which now a judge, let's say you're going up against your tenant and they're suing you, and their attorney goes to the judge and says, Judge, this person, Pace Morby, is using his LLC's funds to go buy tickets to go to Disneyland. It has nothing to do with the business at all. And I can make an argument all day long. Oh, I made a mistake. It was just one time, Your Honor. And the judge says, sorry, go ahead. You can sue him and go after him personally. And now you have a personal liability that you thought you were putting an LLC between you and your business. That LLC is no longer there. That veil has now been pierced. It's called piercing the corporate veil. By the way, it took me about a month to learn that because attorneys don't explain things as stupidly as I do. They're way smarter than me, so they're harder to understand. I'm stupid. This is the benefit I bring to you. My stupidity in explaining stupid things to you is one of my gifts to you. Can you still pay yourself, Travis says, Robert?
Yeah, so rather than just, taking it out of your bank account to go buy whatever you want, the right way to do it is either if you have some sort of a salary through your business or a wage that you get paid, that's one way. You can take a distribution. So that'd be the other way to just distribute the funds, and either way works, but just don't start using the business funds for personal funds straight off the card.
This is really tough. So what Robert was also saying at the very beginning is Robert's saying, hey, guys, when you start an LLC or you acquire an LLC, there should be enough money in that bank account. What'd you call it? Funding?
At the time of formation.
At the time of formation, I need to make sure that there's money in there to basically handle any like immediate liabilities, right? So if it's a dog grooming business, it's probably $500, maybe $5,000 max, right? So that you can show that you've contributed to the LLC. The LLC is there to run, and you're not robbing Peter to pay Paul from your personal account, and you're essentially it's just not a good look. So when you go to get into a lawsuit, guys, by the way, you will get into lawsuits with tenants. So if you have not gotten into a lawsuit with a tenant, it means you don't own enough property. You will get into a lawsuit with a tenant at some point in your tenure as a landlord. You will. So these things and what he's saying is a really good thing. And I would probably say it's the most common thing for sure that I see and I hear about as well. What is the appropriate way to do this?
Some tips here are have separate bank accounts for the business. As you get more advanced, you'll have a holding company and subsidiaries and different affiliates. And so not only can you pierce the corporate veil to go after, an entity that you own, but if you have a subsidiary structure, someone can go after the bottom tier subsidiary. And if you're not managing that subsidiary correctly, they can go up, up the chain. So, when you have different entities like that, you want to make sure you have different governing documents for each entity, that each entity has its own operating agreement or bylaws if you're a corporation. You want to make sure that you're having separate annual meetings for each separate entity. You want to make sure each entity has its own bank account. If there's any sorts of transactions between yourself and one of those entities, like I said, it should be either a distribution, or if you're putting money into the business, you should document it as a contribution. Or if it's a loan, then you should have it documented through a promissory note. You just want documentation that the contributions are for a legitimate business purpose.
Love it. Okay, cool. So does everybody understand that? And does everybody understand how to avoid it? I got a tax distribution today of like $400 and something thousand from one of my businesses because we ended up not having to pay the taxes. So we put our taxes in a separate tax account on on all of my businesses, and assuming that I'm going to pay taxes at the end of the year. But the great thing is I bought enough real estate that I depreciated and I wiped out the majority, if not all, my income. And I was able to get a tax distribution, which means the money I set aside for taxes, I ended up getting as kind of like a little year-end bonus, which is kind of nice. So separate your bank accounts. Make sure you're following profit first. Make sure you're not commingling funds. And on the date of formation, your LLC should have a reasonable amount of money to cover any immediate liabilities. Is that correct?
Sorry, I was reading one of the comments.
Oh, love it. Okay, no problem. $400,000 of a bonus is more than nice. Yes, it is. That's only from one business, Travis. It's a good thing to not pay taxes. Robert, what's number 2, my brother?
All right, number 2 is somewhat related, but I would say another mistake is failing to have a affiliate or subsidiary structure. So some of you I know a lot of you guys might do fix and flips or wholesales or buy and holds. So rather than just operating everything out of one LLC, you really should segment them based on the business, the risk of that specific business and the type of income. So for instance, if you have a wholesale operation, that should be one entity. If you have buy and holds, then that should be another type of entity, really, because you want to separate the liabilities, keep them, you have separate streams of income. You don't want a issue with a tenant to be able to cause you to have to pay out of your wholesale business and vice versa. And then secondly, you might also want to have them structured differently for tax purposes, because one is active income versus potentially passive, depending on how you run your operations.
This is a good question. Melissa says, so when I put money from my personal account into my business account, should I do a promissory note?
You don't need a promissory note if it's not a loan. If you're just contributing capital to the business, that's just a capital contribution. You should update your corporate records that you've made a capital contribution. If you have an operating agreement, typically when you set up the business, it'll list the initial capital contribution. So you'd want to list it there if that's what it is. So you don't need a promissory note unless it's an actual loan that's supposed to be repaid as debt.
Love it. Okay, cool. Number 3, Robert, what do we got?
Number 3, sometimes, especially when you have partners, this can be dangerous, is waiting too long to incorporate, whether that's a corporation or an LLC, depending on what business you're operating. But the danger here is that you can be considered a general partnership. And to be considered a general partnership, you don't have to actually even file anything with the state. So if you want to form an LLC or a corporation, you have to file, either articles of organization or articles of incorporation with the state. But with a general partnership, all it takes is two or more people carrying on a business with an intent to make a profit. It's as simple as that. So, and the danger is that if you guys do this and you're putting any money into the business, you're basically just operating under like the default rules of your state. And in Arizona, for example, the default rule is that you're sharing profits equally. Well, what if I put in 50 grand and you put in 10 grand? You know, maybe that doesn't make sense that we should share profits equally, but that's the law. And more importantly, and this is the main reason you don't want to be a general partnership, is that you are personally liable for the liabilities of the business. And not only that, each person is jointly and severally liable. So if the business has a $100,000 liability, the creditor can go after any of the partners for the whole thing, not just their percentage ownership.
I have a question. Let's say that, but guys, pay attention to this because a lot of people ask this question because a lot of you guys screwed this up, which is fine because I've screwed it up too. I started an LLC, Robert, and you know what? My wholesale fee came in and I started paying my rent payment with that. I started paying my cell phone bill with that. I started paying groceries with that, did all sorts of things with my wholesale money that I made in my wholesale LLC, paid for a lot of personal expenses. Does that mean I should just shut down my company and start a new LLC because I've already caused these problems? Or is there something I can do to remedy it? Or does time basically allow me to repair that issue that I caused?
I don't have a great answer for that one. I mean, you could start a new entity. Obviously, the earlier you are, the easier that is, rather than if you're, you know, way down the line in your operations. If you do start a new entity, one of the concerns might be maybe brand recognition. If you do start a new entity, maybe you buy the name from the other company, so you're able to use that name. As far as how far back, you know, someone can look, I've never litigated one of these. I do a lot more transactional and I set up the entities, but I've never had to litigate and look back. So I don't have an answer for you on that one.
Okay, I have an answer for that one if you don't mind, and tell me what, because
Sure.
I'm not an attorney. I have a $200 watch. I don't know. Don't trust me. I wear a Casio. You know what I'm saying? Don't trust a man that wears a Casio is what I've always heard. So here's the answer for the people that are asking that question. Okay, I deal with a lot of attorneys. I golf with a lot of attorneys. Friends are a lot of my attorneys. We've had these conversations a lot. What typically happens is you have to kind of do the sniff test. The sniff test is if I was standing in front of a judge and I had somebody suing me over something, and that person sued me and they said, we want to see their bank records because we're going to attempt to pierce the corporate veil to go after this person personally. That judge is going to look at your bank records. And if you haven't had any infraction or any issue for 2 years, no judge is going to go back and go, dude, yeah, you're right. You bought Disney tickets 2 years ago. So you're right. There's going to be an allowance. What we typically see is people who are actually committing the commingling within a certain period of time from the day that they're being sued. It's not from like, oh yeah, we did this 10 years ago, but we fixed it. Here you go, blah, 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 blah. 10 years later, you're in front of a judge and judge goes, yep, you're right. You bought those Disney tickets 10 years ago, pierce the corporate veil, go after you personally. It is how you can reasonably argue to a judge because that's who's going to make the decision, right? Somebody's going to make a decision when the facts are laid out in front of you. For me, I have a company called PJ Morby that I commingled a lot of funds on for a long time. Guess what? I still have that LLC. I'm not shutting it down or replacing it or anything else. I have another LLC, Moving Forward Ventures, which I bought a lot of real estate in. Before I knew this stuff, like 5 years ago, I was commingling funds. I have no worry whatsoever from 5 years ago. All of those things have been fixed. I now follow all my corporate rules. We've even gone into our operating agreements to state and document those types of things. Our corporate minutes also reflect those types of things and those types of conversations. And I show in my corporate minutes that those things have been fixed. So if you're not worried about it, like I'm not worried about it, then the answer is no. Don't go shut down your company and go start another LLC. That's tomfoolery, in my personal opinion.
So number 4, what a lot of people get wrong is raising capital illegally. This is a big one because the consequences for not following securities laws is that you can be faced with criminal indictment, criminal conviction. To start, I'll say there's the SEC has its rules, and aside from the SEC, each state has its own set of securities laws as well. Every time you want to sell a security or raise money, if you are offering a security, the offering needs to be either registered with the SEC or you need to meet a exemption from the SEC and a state exemption as well. So
Give me an exemption. Friends and
Well,
family?
no. The most common exemption that we use is called a Regulation D. There's two parts to well, there's a couple different pieces to Regulation D, but there's two that are mainly used. I'm sure some of you have heard of them. The first one is Rule 506B. That allows you to raise funds up to an unlimited amount of funds from as many accredited investors as you'd like, and up to 35 non-accredited investors. Realistically, when someone uses 506B, we're not typically including non-accredited investors, because once you add in non-accredited investors, you have to provide certain disclosures, and it gets a lot more expensive, and it's a longer process to lump them in.
You
And a
know,
lot
you guys know how I think about accredited and non-accredited investors and why people don't like non-accredited investors. Think about a really high-end gym. A really high-end gym is like, we don't want to deal with children and people bringing in their kids. It's going to be a yoga studio. We only want yoga people coming in here. And when people are coming in here dropping off their kids, now we got to hire more people to take care of these kids. And we have to have a whole nother space just for the kids in here. How do we just create a yoga studio just for people that want to do yoga? That's exactly what he's talking about. Here's what I did last year. I created two 506Bs. We raised 40 million, something like that, primarily all through accredited investors. And then what I did this year also is I created my first Reg CF, which allows me to crowdfund from, unfortunately, only up to 5 million bucks. It costs so much freaking money to create these additional layers of accountability, reporting, babysitting. Essentially, working with non-accredited investors is a layer of babysitting. And most people don't want to do that. It doesn't feel good to hear that when you're a non-accredited investor, but that's why we called our non-accredited investor fund the little guy fund, is because I don't want to leave the little guy behind. And we're going to allow people to invest with as little as $1,000 in our multifamily stuff. But unfortunately, there's limitations in all of these types of things. And so does everybody understand the difference between non-accredited and accredited investors? This is a great question. Write this question and write this answer down. He's an attorney, so he's going to say it depends, but I'll give you guys my experience. By the way, you can always tell what any attorney's answer is always going to start with, right? Robert, how many times do you say it depends every day?
all the time.
All the time. In fact, that's the name of his law firm, guys. It depends law firm. But that's what a good attorney does, right? They go, well, what are the situations? Okay. The most expensive thing is writing your PPM and your offering. Your PPM is your private placement memorandum. It's essentially a thick document that tells your potential investor every which way they're going to lose money. And it's going to tell them who you are, who your other partners are, everything about the company, all the things, the nitty gritty, all the bad stuff is going to go into this PPM, plus all the good stuff. Like, here's what we hope to do. Here's what, da, da, da. It's basically like a very, very thick business plan with all the ways that could potentially fail. You understand that you have been educated, you've been told, you've been this, you could potentially lose your money. If you lose your money, you can't come back and sue the people, blah, 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 whatever. Okay. My experience is that putting a fund together, just the documents, write this down, just the documents. This doesn't include actually raising the capital. It doesn't include the capital raiser's salary. It doesn't include managing people after the fact. It doesn't include reporting after the fact. It doesn't include any of that. Okay. PPM stands for private placement memorandum. Okay. It is a glorified business plan, and every which way you're going to lose money. You have to give it to an investor before they give you money. Okay. You have to, and they have to sign off on it. And if you go the accredited route, you have to raise capital with only accredited investors, and they have to have a CPA sign off on them being an accredited investor. You can't just have somebody go, yeah, I'm accredited, and then take their money. You have to have verification that they have to be verified. Okay.
All right. Number 5 is a lot of business owners will come to us either without an operating agreement, or they just grabbed an operating agreement off the internet. This is one of the most common ones, aside from the piercing the corporate veil issue that we see. And if you're just operating a business by yourself and you're the single member, it may, not the biggest deal in the world. But the second you start to bring in other members in the LLC with you, you really need to have a solid operating agreement. And, when you grab on a template you grab online, might not be the best fit for your specific business.
I don't know what your thoughts are on this, but a good operating agreement, in my experience from a really good attorney, is going to cost you anywhere between $3,000 to $7,000, and especially with them spending the time and energy on understanding your individual business is really important. So what I did for the sub 2 students is I paid. Let's see here. All right, so check this out. Operating agreement right here, September 15th. Okay. I created an operating agreement and a buy-sell agreement right here. Make sure you go in here. Cost me $4,000. Now, it doesn't mean, okay, the December 22nd, here you go. I reposted it right here. Buy-sell agreement, operating agreement right here. I paid an attorney to do this. Cost me $4,000. Okay. And oh, by the way, I also did a whole thing about partnering with people. Do not partner with people who do not deserve it. Do not partner with people until you've had a successful dating period. And I did a whole entire Dropbox video about partnerships, et cetera. So be very careful on who you partner with. But go in here, December 22nd, type in operating agreement in the Facebook group. You guys will see this. It's a $4,000 document I gave to you. Say thank you like I spent $4,000 on you, because I did. Very important for you to have an operating agreement. We didn't talk about this beforehand. I love all 5 of these. These are great. I can't even wait till the other 5 are talked about.